Hey everyone, and welcome back to the channel. Today, we'll be diving into a seismic event that shook the financial markets to their core over the past few days. We're talking about a perfect storm, a convergence of stress across both precious metals and the crypto world that has left even seasoned traders breathless. This wasn't just a bad day at the office, it was a systemic shock that revealed some deep cracks in the market's foundation. Let's start with the traditional safe havens, gold and silver. These are the assets people flock to when uncertainty hits, right? While they experience price movements that were, to put it mildly, exceptional. While you could argue the volatility was technically within historical ranges, the sheer scale and timing were staggering. Silver took an absolutely brutal hit, plummeting more than 30% in a single session. Think about that for a second. 30%. Gold didn't escape the carnage either, dropping roughly 14% based on settlement prices. For assets that are supposed to be the bedrock of stability, these moves were a massive red flag. Now let's pivot to the digital frontier, cryptocurrencies. At the exact same time the metals were getting hammered, the crypto market was descending into its own chaos, a period of what we can only describe as acute liquidity disruption. Bitcoin, the king of crypto, wasn't spared, declining by about 13%. Ethereum, the backbone of DeFi and NFTs, fared even worse, falling nearly 25%. The real story here, though, is the domino effect of liquidations. We saw estimated liquidations exceeding a mind-boggling $2.5 billion, all happening in a series of tightly clustered destructive waves. It was a cascade of forced selling that just kept coming. So what on earth caused this synchronized meltdown? It wasn't about a sudden change in the fundamental value of gold or the long-term potential of blockchain. No, what we witnessed was the raw, brutal power of market mechanics. The real villain in this story is leverage. Across both asset classes, the stage was set by an enormous buildup of leverage. Traders were making massive bets with borrowed money, creating a house of cards, a fragile equilibrium just waiting for a gust of wind. Think of it like this. A huge number of traders had placed bets that prices would go up. They borrowed money to amplify those bets. But when prices started to dip, even slightly, they hit what are called margin call or liquidation thresholds. These are automated tripwires. Once a position's value drops to a certain point, the system automatically sells the assets to cover the loan. This isn't a human trader panicking. It's a cold, hard algorithm executing its code. And that's where the cascade begins. The first wave of automated liquidations pushes prices down further. This drop then triggers the next level of liquidation thresholds for other leveraged traders. More forced selling hits the market, pushing prices down even more. It becomes a vicious, self-reinforcing cycle. Each wave of selling begets the next, creating a downward spiral that feeds on itself. This is what we mean by mechanical forces dominating the market. The fundamentals didn't matter anymore. The only thing that mattered was the relentless pressure of forced selling. This cascade effect completely overwhelmed the available liquidity. Liquidity is essentially the pool of buyers ready and willing to step in and purchase assets at a given price. But when you have billions of dollars worth of assets being forcibly dumped onto the market in a matter of hours, there simply aren't enough buyers to absorb the selling pressure. The buyers who are there either step away, waiting for the storm to pass, or they demand much, much lower prices. This liquidity vacuum is why we saw such dramatic and terrifying price drops. The market's support structures simply broke. What this event really highlights is the structural fragility that high leverage and automated systems create. In the crypto world, this is a well-known feature, or bug, depending on your perspective. The entire ecosystem of perpetual swaps and DeFi lending protocols is built on these mechanisms. But seeing a similar dynamic play out in the precious metals market, albeit through different instruments, is a stark reminder that no market is immune to the dangers of excessive leverage. When you have so much leverage concentrated in the hands of a few large players or spread across thousands of retail traders, you create a system that is incredibly sensitive to shocks. A small move can trigger a chain reaction with devastating consequences. The market's behavior ceases to be a reflection of collective human sentiment or economic outlook, and instead becomes a purely mechanical process, a series of dominoes falling one after the other. This recent turmoil is a critical lesson for every single investor and trader. It shows us that understanding market structure is just as important, if not more important, than understanding an asset's fundamentals, especially in the short term. The plumbing of the financial system, the way trades are settled, the way leverage is managed, and the way liquidations are handled, can have an outsized impact on prices. These are not just boring back-office details. They are the gears that can either keep the machine running smoothly or cause it to grind to a catastrophic halt. So where do we go from here? For one, we can expect regulators to take a much closer look at leverage, especially in the less regulated corners of the crypto market. But for us as individuals, the key takeaway is to be hyper-aware of the risks. Understanding that these cascades can and do happen should inform our own risk management strategies. It's a reminder of the importance of not over-leveraging your own positions and being prepared for extreme volatility, even in assets you consider safe. The markets have given us a masterclass in systemic risk. It's a painful one, for sure, but an invaluable one. We saw how interconnected these seemingly separate worlds of old money and new digital assets really are, and how the same mechanical forces can wreak havoc across both. This wasn't just a market dip, it was a stress test, and it revealed some serious vulnerabilities that everyone needs to pay attention to. That's all for today's deep dive. This was a complex topic, but I hope this breakdown helps you make sense of the chaos we've just witnessed. The markets will stabilize, as they always do, but the lessons from this event will stick around for a long, long time. Thanks so much for watching. If you found this analysis helpful, please hit that like button and be sure to subscribe for more content that goes beyond the headlines. Stay safe out there, and I'll see you in the next video. Have you ever watched a market go completely haywire and wondered, what on earth just happened? One day, everything seems fine. The next, prices are swinging wildly and the news headlines can't keep up. It's a common feeling, especially in today's fast-paced financial world. We're often taught to think about markets in terms of fundamentals, supply, demand, company earnings, economic growth. But what if I told you that in the short term, something else is often pulling the strings, something more mechanical, more hidden? This is the core principle we're diving into today. Short-term price behavior is frequently a game of structural configuration, not just fundamental value. Think of it like a finely tuned machine. The fundamentals might be the engine's horsepower, but it's the gears, the pipes, and the pressure valves that determine how that power is actually delivered. In markets, these gears are things like leverage, the depth of liquidity, margin policies, and how traders are positioned. These are the invisible forces that can create either stability or chaos. Let's look at two fascinating and very different markets to see this in action. Precious metals, specifically silver, and the world of crypto. On the surface, a lump of silver and a string of digital code couldn't be more different. But underneath, they both follow the same structural laws of motion. First, let's talk about silver. Recently, we've seen some serious pressure on the price. A lot of that wasn't because the world suddenly decided it didn't need silver anymore. Instead, it was about market structure. We had a situation with elevated delivery obligations. Basically, a large number of contracts promising to deliver physical silver. At the same time, the actual physical supply of silver was tight. It's like a game of musical chairs where there are more players than chairs. When you have this kind of setup, it creates a fragile environment. The market saw forced selling, likely from traders who were over-leveraged and had to close their positions to meet margin calls. This selling pushes the price down, even if the long-term demand for physical silver is strong. But here's where it gets interesting. This forced selling can't last forever. Once it subsides, what's left? You have a market where a lot of short positions, bets that the price will fall, are still open. Now, imagine you're one of those short sellers. You need to buy back your position to close it out. But if there isn't much liquidity, meaning not many people are willing to sell to you at the current price, you're in a tough spot. Even a small amount of buying pressure from people like you trying to exit their shorts, or from new buyers entering the market, could cause the price to snap back upwards in a dramatic way. This is what we call latent upside risk. The potential for a sharp price increase is coiled up like a spring, hidden by the temporary chaos of forced selling. It's a classic example of structure, the mismatch between paper contracts and physical supply, overruling the day-to-day news flow. Now let's pivot to the digital frontier, cryptocurrency. If silver is a game of musical chairs, crypto can sometimes feel like a high-wire act without a net. The structural forces here are even more amplified. We just witnessed a wave of liquidations across the crypto space. What does that mean? It means traders who borrowed money to make bigger bets using leverage got wiped out. When the price moved against them, their positions were automatically sold off by the exchanges to cover the loan. This creates a cascade effect. The first wave of liquidations pushes the price down further, which then triggers the next wave of liquidations for traders at a slightly lower price point, and so on. It's a brutal mechanical process that has very little to do with whether a particular blockchain project is revolutionary or not. It's all about leverage and margin calls. The good news, if you can call it that, is that these massive liquidations act like a forest fire. They burn out the deadwood, the excess leverage, and reduce the immediate risk of another crash from the same cause. The system is deleveraged. However, the danger isn't gone. It's just changed shape. Now, the risk lies in concentrated positions near key technical levels. Think of a big psychological price point like $50,000 for Bitcoin. If a huge number of leveraged positions are clustered just above or below that level, it becomes a new point of fragility. A small move through that price could trigger another, albeit smaller, cascade. The structure of who is positioned where becomes the most important thing to watch. So we have silver with its physical versus paper tension, and crypto with its high-octane leverage cycles. But there's another layer we need to add to this picture: the big, wide world. Geopolitical events and macroeconomic news, things like interest rate decisions, inflation reports, or international conflicts, act as external shocks to these already fragile market structures. Think of it this way. If a market is already stressed due to high leverage, an unexpected negative headline can be the spark that lights the fuse. It changes how everyone perceives risk. Suddenly, traders who were on the fence rush for the exits, amplifying the mechanical stress and accelerating the liquidations we talked about. On the other hand, a positive external shock could have the opposite effect. It might give traders the confidence they need to hold their positions, allowing liquidity to return and the market to stabilize. The context of the shock is everything. The same piece of news can have a wildly different impact depending on the underlying structural health of the market at that moment. So where does this leave us? If you're looking for a simple forecast, like silver will go up or crypto will go down, I'm afraid you're going to be disappointed. The current conditions don't support that kind of deterministic prediction. It's not about being certain, it's about understanding the probabilities and the potential for explosive moves. We're in what you could call a conditional volatility regime. The outcome isn't predetermined. It depends entirely on how these structural factors play out. Will the residual leverage in the system get flushed out cleanly? Will liquidity return to the market, providing a cushion? How will the tension between the paper market and the physical supply resolve itself? And how will traders react to the next inevitable external shock? These are the key questions. Stabilization is definitely possible. Markets can and do heal. But we have to be honest and acknowledge that the vulnerability remains high. The structure is still fragile. The next major phase for both metals and crypto won't be defined by a brilliant new analysis of their fundamental value. It will be defined by how these powerful underlying structural forces resolve themselves. It could be a gradual normalization, a quiet return to business as usual as liquidity seeps back in, or it could be another sudden violent episode of forced repricing, another what on earth just happened moment. The key is to stop looking only at the surface and start paying attention to the machinery running underneath. Understanding the interplay of leverage, liquidity, and positioning is your best tool for navigating these incredibly complex and fascinating modern markets. Thanks for sticking with me through this deep dive. If you found this perspective helpful, make sure to like this video and subscribe to the channel for more analysis that goes beyond the headlines. Let me know your thoughts in the comments below. See you next time.